break down an IUL for beginners, okay? So this is you. You're considering getting an IUL, but you're not really sure how they work or if it's right for you. So an IUL is something that's going to allow you to store your money, accumulate interest, access that cash, and be able to pass it down to your heirs tax-free. So you get to determine how much you want to put in. So for this scenario, you're going to save $500 per month, and you're going to put that into your indexed universal life insurance policy. This will be housed with an insurance company. So you're going to pay $500 to the insurance company, and that money is going to split amongst really three different ways, but two different ways right here. A small percentage of those funds are going to go towards a death benefit, an immediate death benefit, typically about 10% of your contribution. It's based off your age, health, and gender, of course, but for this scenario, we're gonna say about 10%. So in this scenario, about $50 is purchasing a death benefit. So if you were to pass away tomorrow or get sick, critical, chronic, terminal illness, critical injury, that $200,000 is going to pay out to your family to aid in cancer treatments or anything like that, or personal expenses, and or if you pass away, it's going to aid in their burden that they just lost you in their house expenses. But the remaining portion of your funds, this is the overfunded contribution. This is elective, right? Because this is required. You have to pay this for the life insurance policy. But this other $450 is going towards an accumulation account. This is your account with the insurance company that is linked to an external index. An example of an external index is the S&P 500, as much of you have heard of. On average, it's going to yield somewhere between 7 to 10% per year in upside growth. So you'll accrue interest in this account. However, your accumulation account is not directly invested in the market, so it is not exposed to losses. You have a contractual guarantee to have a floor of like 0%. So when markets go negative 10%, you don't lose the money. You participate in upside without risk to downside in your accumulation account. And then from here, the insurance company extends you another account called a cash value account. We call this your retirement account or your bank. It's essentially a line of credit with the insurance company that is collateralized with the account value. And the reason you want to have a line of credit is because you can take loans from the insurance company, and loans are non-taxable events. So if you accrued interest above basis, above your contribution amount, you can access that cash tax-free. So as long as you have money in here, you can take tax-free loans back to you. It does not have to be paid back. You're not forced to pay it back, because eventually when you pass away, it'll just be deducted from your account value that was going to pay out to your family, okay? It can be accessed at any time in your life. So as long as there's money in this account and it was properly structured, you can take loans from that without question at any time in your life. It does not interrupt accumulation account. So if your accumulation account is doing 7%, and your loan in your cash value account, if you take a variable or participating loan, is at 4%, you have the potential to still have that arbitrage there. So you would still be making 3% on your account value if the interest in your loan was only 4%. So you're making money and the insurance company is making money. And that comes back to you. So you could use whatever you want it on. It could be for personal expenses, kids' college expenses. It could be for investments, other real estate projects, other investments in the stock market, whatever you want to do, you could use those funds. However, a lot of people like to set these up to use it as a supplemental retirement account. They'll use it to either bridge the gap between like 50 and 60. If you have like a 401k or an IRA that's a qualified plan that they can't touch till 60, but they want to retire at 50, they get super aggressive and fund these sooner, and they'll take retirement for about 5 or 10 years sooner, and they'll take it from here, right? Or people just use it to supplement the retirement at a later date, because again, they can take loans out tax-free without having risk to the market.